welcome. I'm Mark Todd from The Map, and today I'm talking to Adam Watson. He's the CFO of Transurban. We'll talk about the first half results and a little bit of his views on the capital story, on the growth story, and what Transurban is doing and what you've learned. Adam, welcome. Thanks for taking the time to chat.
Thank you very much. Yeah, appreciate it.
So, obviously, half-year results, you go out and talk to analysts and investors. What's the general tone? What are they asking you about your business?
So we have been on the road for a number of days now and seen a lot of investors, and it's been a very positive story generally. So our traffic numbers have been strong as always. We've seen a few mixed results around some of the assets. In Brisbane, we've had a little bit of disruption on the Gateway and Logan because of the Gateway Upgrade North project and Logan enhancement projects, but they're just about finished, so we'll see them normalise next year. There's been a little bit of noise around New South Wales. We've seen a little bit less truck traffic on the M7 for a few reasons, but generally across New South Wales it's been quite strong. And in CityLink we're seeing quite strong growth. So the results generally have been good. We get a few questions around the state of the economy, as we're somewhat of a barometer around the state of the economy, but we're seeing still strong truck growth. We're seeing strong weekend travel. So again, the underlying results are really positive. We've done a lot since the acquisition of WestConnex, which we acquired late last year, to turn very quickly to driving operational efficiency, continuing to focus heavily on our customer and providing benefits to our customer, as well as the travel time savings that our assets provide, and also focusing our development pipeline on a few of the targeted areas that we want to concentrate on.
Fantastic. It's great to hear that the analysts and investors like it. I think the dividend story is something I want to talk about. There was a capital release of $98 million to supplement the dividend distribution of $775. Free cash flow was $715. Can you help everyone understand the strategy around the dividend distribution at the moment?
Yeah, so again, the underlying cash flows continue to be very strong and very positive, and again, the consistency of our growth profile is something that attracts a lot of investors to us in terms of the capacity to continue to not only pay a distribution, but continue to grow the distribution consistently. When we acquired WestConnex last year, we undertook a large equity raising, and we've been very thankful and humbled by the support that we received from our investors through that approach. But we also thought that we needed to structure that transaction in a way that we could maintain our distribution growth in that mid-single digit per annum level. And we did that by using capital releases as a source of funding to top it up. So again, the vast majority of our distribution and our cash flows are supported by the underlying cash flows. By being able to use capital releases, which is effectively just a way where we can recapitalise our balance sheets, making sure that we maintain very strong credit metrics so that they're very credit worthy and we've got a very strong balance sheet. But where we've got excess capacity, being able to raise funds and use those funds to supplement the distribution whilst we wait for the new projects coming online. So when you take WestConnex, for example, you'll see a slide in our investor presentation where you see the cash flows coming on strongly over the next couple of years. But in the short term, we want to supplement that with these capital releases. That's
the sort of feedback I get when I talk to the investors, that it's a similar narrative to what you're describing. In your mind, what are the headwinds to that strategy in terms of, here's a distribution strategy, this is the execution? What do you see as potentially the risks to that strategy?
When we've undertaken this, obviously we've done it with a lot of focus around the credit metrics. So again, making sure that we've got strong balance sheets for all of our assets and those assets where we are obtaining capital releases. And we think that that's a very smart thing to do and provides long-term flexibility for the organisation in terms of how we can maximise the efficiency of our balance sheet in a very prudent way. So we're comfortable with the way we do that. Our capital releases aren't tied to any sort of immediate trigger events. So again, it's not as though that there's something that could impede it that we can't manage. So again, we're very focused on that. And importantly, again, just coming back to making sure that the underlying cash flows and the underlying operations are strong, which again, part of our business model provides that comfort. We build in a lot of buffer to make sure that we aren't dependent on capital releases from a timing perspective. And as you know, and as you've heard us talk a lot about before, We continue to seek to pay out approximately 100% of free cash over time. It may mean some years we're a little bit below 100%, at some years we're going to be above 100%, but what we know our investors appreciate is a consistently growing distribution rather than having volatility built into our distribution profile. So again, capital releases help us manage that.
Customers are very reluctant to embrace volatility. They like to have an idea of where the company's going, so talk to me about the growth prospects for the company. What else is on the horizon in your mind?
Yeah, so first and foremost, again, just to reiterate that our investment in WestConnex is going to provide us with a lot of growth in the future and a lot of embedded growth in the future. Again, as you can see on the chart with the new construction program underway and the completion of those activities over the next couple of years, we're going to see a big step up in cash flow and ultimately, again, supporting the distribution growth to support that investment will be a feature of the business over the next couple of years. So we've got a lot of embedded growth anyway, hence why our real focus at the moment is delivering on the construction program. Again, driving operational efficiency, you'll see that our cost growth was very low during the period, 1.5% underlying cost growth, excluding foreign exchange. So again, we've been very focused on the underlying operations. And then in the near term, and once we get through this delivery phase or the delivery focus phase, we do have a lot of embedded growth across our network. So for example, the Logan asset in Brisbane will need to be widened over the next decade. You've got the M7 in Sydney, likely need to be widened over the next decade. And then you take the US businesses, and particularly around Washington DC and Maryland and the like, there's a lot of development opportunities we see in the near term there.
They love freeways over there.
They do, and they need them.
They definitely need them. It's the rust in America, isn't it?
Yeah.
It's great to hear it's all about the execution phase, because then that's what you're an expert in. So congratulations on the first half results. Thanks for taking the time to chat to me. It's been very interesting.
Thank you.
That is Adam Watson. He is the CFO of Transurban. I'm Mark Todd from the NAB. Hope you enjoyed the video.